Hello guys, my name is Bryan Christian and I'm from Faculty of Economic and Business, Pajajaran University. Today, I with my teammates will present to you about Chapter 4, Linking Corporate and Financial Strategies. But before that, I will introduce my fellow teammates. So the first is Fahmi Septiana. Second, Hisbi Asyihristani. And the last, Muhammad Fatan Basar. Okay, so let's start this presentation. Okay, so in this chapter 4, we will discuss about financial strategy, including a company choice of sources of finance and its dividend policy, and relate this to the business risk of a company face. Business risk is the inherent risk associated with the underlying nature of the particular business and a specific competitive strategy that is being implemented. It relates to everything except the risk from the financing structure. Financing risk is about the debt or equity mix. Debt and equity have a different risk profiles for investor and company, and their use has to be balanced to meet the company's particular circumstance. It is inappropriate for a company with high-risk business to adopt a finance strategy that involves high financial risk. Similarly, for public companies, it is unwise for a low-risk business to use mostly equity, which is low-risk finance. A life cycle model is introduced, which considers the risk companies face at the launch, growth, maturity, and decline stage. From this, we can draw up a profile of the suitable financial strategy for each type of company, showing how its financing and its dividend policy should change as it develops. This chapter 4 will be a long chapter because there is whole theoretical foundation behind the model we use, plus uh, the example of its use. But we believe that is important to understand the thinking behind the model before you take the liabilities with it. Okay, so the next slide, it will be explain uh, what is learning objective of this presentation. First, distinguish business risk and financial risk, and explain why there should be an inverse relationship between them. Second, explain the different elements of financial strategy. Third, assess how risky a particular business is with a view to understanding how it should be financed. Fourth, understand the 7 drivers of value and how they can be related to business strategy in order to increase value. Fourth, or the last, discuss how the elements of financial strategy might apply differently to public and privately owned companies. Okay, next slide. You can see a picture uh, in this in this slide is a simple model for a preliminary analysis of business risk. Okay, so in this picture, the constituents of profitability are broken down to facilitate analysis. As business risk relates to variability in operating results, it seems reasonable to examine the factor making up these operating results, which takes us back to the basic accounting model. Sales less cost is equal to profits. We can then begin to see what effect each of these items for our particular company. For sales, it might be appropriate to examine what affects our selling price and the volume we sell. Or an analysis of products and markets may be more useful, or both may be used. For cost analysis, a preliminary approach may be to determine the operating leverage, the relative level of fixed to variable costs. On the basis that companies with high level of fixed costs may have difficulty achieving break-even when the sales fall. or the sales it's get done. The level of committed cost may also be important, or a business with a high committed to forward expenditure is more vulnerable than one with no such a commitment. Okay, maybe the next material will be presented with my other teammates. Thank you.
Okay, then I will continue the presentation of this material. My name is Fahmi Septiana Nugraha, and in this presentation, I will explaining the element of the business risk. Here are some examples of the problems that we need to consider when analyzing business risk. First, demand volatility, which can be affected by market factors, change in consumer preferences, short product life cycles, and actions taken by competitors. Second, input cost volatility, which can be influenced by the number and the strength of suppliers, the efficiency of production, the relative level of fixed costs, reliance on commodity markets, and the level of commodity costs in the terms of volume and price. Third, growth drivers such as the ability to develop new products, the ability to expand to new locations, and the ability of the current management team to take the company to the next level of growth. Fourth, selling price volatility, which can be affected by market factors, price wars, economic conditions, prices and substitute and complementary products, and oversupply or shortage. Fifth, expense volatility, which can be influenced by reliance on key suppliers and relative level of fixed costs. The significance of expenses relative to the size of the business and the level of committed costs. And sixth, other issues to consider include industry analysis, political analysis, working capital needs, and exposure to currency risk. Furthermore, there is an analysis strategy here. Before we dive into financial strategy, let's take a quick look at some useful strategy tools that can help improve our analysis of business risks and opportunities. First is Porter's five forces. In his book Competitive Strategy, Michael Porter outlines five forces that drive industrial competition, such as the relative bargaining power of buyers, the relative bargaining power of suppliers, the threat of new entrants, the threat of substitute product, and the degree of rivalry among existing firms in the industry. The relative strength of this force can indicate the attractiveness of an industry to a particular player and suggest where they might want to compete. The pipe force model can also be used to inform the analysis of business risk. By rating the threat posed by each of the five areas, we can get a quick picture of the attractiveness of an industry. We can then focus on the key force and develop business strategies to preserve our advantage or mitigate threats. Second is spatial analysis. In analyzing companies' competitive position, it is essential to understand how change will impact it. Some of the key drivers of change are political, economic, social, technological, legal, and environmental issues. A vessel analysis considers how these factors are likely to affect the company and the industry in which it operates. It is recommended to conduct a pipe force analyzing at the current time and then consider how the special factors will impact that analysis. The business strategy and risk assessment should then take these factors into account.
Okay, I will continue this presentation. Hello, my name is Hisbi Asyihristani. I will continue the presentation starting from resource-based theory. In resource-based theory, we can analyze the competitive advantage approaches that lie in the characteristic of an industry. By understanding the spectrum of an industry profile, we can determine the possibility of a company to compete. The factors are known as PIM, valuable, rare, imperfectly imitable, and non-substitutable. The first one is valuable. With this advantage, companies can produce goods or services more efficiently at more competitive prices, which can help increase profit margins. And second is rare. In the rare industry, a competitive advantage can be obtained by having unique resources of the technology that are only owned by a few companies. This can allow the company to have lower costs or offer more innovative products to consumers. Third point is imperfectly imitable. In this condition, the industry has advantages that are difficult for rival companies to imitate. One of the advantages is that the company has a very high reputation, but in the eyes of the consumer or the unique production process. And lastly, there are no conditions where there are no products or services in the industry that can be used as effective substitutes for the products or services offered by the company illustrate non-substitutable competitive advantage. This can help the company to control prices and increase its profit margin. And next is developing strategies to enhance shareholder value. This feature solves the strategies developed by internal and external analysts by reflecting the relative values of the seven value drivers. By carrying out and designing the right performance, the target of the company will be achieved. However, in reality, it is not always that simple because these values are also a function of management capability, and any strategy will not be successful if it's not implemented properly. Corporate governance also plays a role in managing the company and shaping market perception. Finally, shareholder value in the short and medium term depends on the market itself. In promoting financial strategy, companies must consider relevant value drivers and look for ways to increase corporate value by utilizing or optimizing these value drivers. Some strategies include increasing sales growth, increasing operating profit margin, reducing cash tax rate, reducing incremental investment capital expenditure, reducing investment in working capital, increasing the time period of competitive advantage, and reducing the cost of capital. And next is decision in financial strategies. Aspects to be decided on in the financial strategy. The first one is how large should the asset base be. A large asset base is usually considered to be more stable and better equipped to handle risk because it has more resources that can be used to cover deficiencies or overcome emerging problems. However, an asset base that is too large can also be a burden for the company because it can increase operating costs and slow down the company's growth rate. And the second is how much of the finance should be debt. The financial structure of the company or the proportion its financing that comes from debt and the proportion that comes from equity is one of the factors that affect the value of the company from a financial perspective. The higher debt financial structure is generally considered riskier because the company is reliant on debt to cover its financial needs. However, a high debt financial structure can also increase the company's profit margin because the cost of debt is usually lower than the cost of equity. And third is how much should be paid in dividends. Dividends have an impact of the value of the company and its attractiveness to investors. Dividend payment made to shareholder out of the company's profit, and they can affect the value of the company in several ways. The first one is dividends can affect the value of the company by affecting its retention ratio. And then second one is dividend can also affect the value of the company by affecting its cost of the capital. And the last one is how to issue new shares. This decision can affect the company ownership structure and financial position as well as its attractiveness to investors. Issuing new shares can provide the company with additional financial resources that can be used to support its growth. However, issuing the new shares can also reduce the value of the company shares because it will increase the number of outstanding shares, which may decrease the value of each share.
The materials within the next few slides will be presented and explained by me. Before we dive deep into the topic, allow me to introduce myself. My name is Muhammad Fatan Basar, and now I'm going to explain to you about financial risk. Financial risk relates to the level of debt a company is carrying. In assessing the riskiness of debt and equity, it is essential to specify the perspective from which the analysis is being made. This is diagrammatically illustrated with respect to debt and equity funding as shown in the slide. A bank will try to reduce its financial risk by a whole series of actions. This includes ensuring that it has priority in terms of both repayment of principal and payment of interest, which can entitle it to demand early and immediate repayment if the financial position of the borrower appears to deteriorate. This step transfers a large part of the financial risk to the company. On the other hand, the financial rights of the same company shareholders are minimal, and hence their financial risk is higher. Companies can choose whether or not they are willing to pay dividends, whereas the payment of interest is effectively committed and mandatory. For the purpose of this discussion of business and financial risk, our perspective is that the company raising funds and then investing it. Consequently, although the shareholders' risk associated with investing in equity is quite high, the financial risk of using predominantly equity financing from the company's perspective is much lower than if a high proportion of debt funding were used. Financial risk should complement the business risk profile in order to develop logical alternative financial strategies for different types of business. Combining a high business risk strategy with a high financial risk strategy gives a very, very high total risk profile. Such a company may succeed massively, but it is much more likely to fail completely. As illustrated in this matrix of business and financial risk, the combination of strategies in quadrant 2 is not logical, long-term basis for creating a successful business. Referring to the matrix of business and financial risk, this means that high business risk companies should use low-risk financing as shown in the quadrant 1 of the matrix. The greater problems at this very simple level of financial strategy tend to be encountered with the lower business risk companies. In general, business risks tend to reduce as companies mature, not least because the unsuccessful one will fail and cease to exist. Therefore, if the initial financing has been raised in the most relevant from equity, the financial structure of this more mature company can easily stay predominantly equity-based. Unfortunately, this can result in disastrous combination of low-risk business strategy and even lower financial risk, as shown in the quadrant 3 of the matrix. The result of this simple analysis is that there should be an inverse correlation between the business risk of a company and its financial risk profile. At this point, we should point out that although much of what we say in this presentation is relevant to all companies, the issue shouldn't be applied by the owner of or manager of private companies. The situation in a private company is very different. The directors are often the owners, and even they are not, there is likely to be a strong link between the two. The directors can ask the shareholders directly what they want from the company. Shareholders in private company may be resist to take on any debt. And as private companies cannot suffer the threat of a hostile takeover, there is no need for them to follow the prescribed strategy of gearing up a low-risk business. So that's it all for today's presentation. Thank you so much for your time and attention. We also would like to apologize if there were mistakes, and we hope you have a nice day.